Okay, good evening, everyone. Welcome to this current webinar session titled Paving the Way to a Successful Private Practice. So on behalf of the college and all the young fellows, I'd like to welcome you all to this webinar. So my name is Mithra Sridharan. I'm a hepatobiliary surgeon. I work here in Melbourne, mainly at Monash Health at Clayton and also at St John and God in Berwick. One of the big things that happens when we finally get our fellowship and our letters is we know all about our clinical work, but we have no idea what to do afterwards, how to start an actual business and a practice. But before we go any further, as is tradition here at RACS and in Australia, we'd like to start with our welcome to country. So RACS acknowledges the traditional owners of the country throughout Australia and recognises their continuing connection to land, waters and community. We pay our respects to them and their cultures and to elders, both past and present. So before we go any further, I'll just let you know what tonight is going to run like. So we've got sort of two sessions. The first session is going to involve a question and answer with Mr. Bernard Lim, who is a very successful oral and maxillofacial surgeon. So Bernard achieved his craniofacial fellowship from London's prestigious King's College Hospital. And he runs a very successful private practice and consults at the Austin, where he practices a full range of maxillofacial surgery, treating patients for benign and malignant pathology, facial trauma, and dentofacial deformities. And also, afterwards, we'll be hearing from Michael Waycott, who is part of the Bongiorno group. So a lot of people here might have heard of the Bongiorno group. They're quite well known, and they've been a very proud sponsor of many, not just college, but also university functions. They are a financial services firm that works solely with medical professionals and have been a proud supporter of the college for over 30 years. So they are a very, very keen participant in our preparing for practice and starting out in private practice workshops. So if you haven't actually been to one of these, I highly recommend it. I went last year, it was fantastic. And they also sponsor the Surgical News podcasts and the Bongiorno National Network Young Fellows Travel Grant. So before we kick off, there's a bit of housekeeping. So we will have questions and answers, and we'll be directing all your questions through the chat function on Zoom. So please write and direct who you direct your questions to, and we'll have a chance at the end of the presentations to go through them. So this will allow us to all run on time. We're also recording this session, so a link will be available on the RACS website in the next day or two for everyone who's registered. So to kick off tonight, I'd like to introduce Bernie Lim and one of our Bongiorno representatives, Gajan Sundaram. Take it away.
Thanks very much, Mithra. Thank you for the introduction, and thank you to you and RACS for the opportunity to speak today. It's always a pleasure. The end of the year is strangely upon us. It's been a very strange year and a challenging year at that. But as we draw closer to the end of the year, it often gives us a time for reflection on the year past, but also promising a new year and new objectives and goals. And that's part of the reason that you're all here today, is to have a look at planning for your life ahead for the year upcoming and life in the world of private practice. So hopefully we can give you a few tips to send you on your way today. So we thought we'd do something a little bit different today, and to start today's presentation, we thought, what better way to frame the discussion than to hear from someone who's faced the same challenges as you and has come out the other side with a highly respected, highly successful practice and a well-rounded full life. So please welcome Bernie Lim. Hi Bernie, how are you?
Hey Gajan, thanks for having me.
No problem. Bernie, I might fire a few questions to you. Now, you were a very bright student. You graduated top of your class in dentistry back in 1999, and you've since gone on to become a very successful oral and maxillofacial fellow. So you spent your fellowship year working at the prestigious King's College Hospital in the UK, and since then you've gone on, as I said, and created a very highly successful practice. So what are some of the more important things you think you've learned from a financial perspective that have helped set you up to where you are today? I think
looking back from when I first came back from fellowship was that I got advice early And I think that's very important. So, when you come back from fellowship, you've got a lot on your plate. You obviously trained up in medicine and surgery, but I don't know about you guys, but I had no knowledge on finance. So you've got to think about a new job, both in a public and private setting. You've got to look at accommodation, and you've got to start to build up your financial well-being, because this is where it all starts when you come back from fellowship. So when I got back, we actually looked around. We looked at different financial planning firms, and as you know, I set it up with Michael because I thought he was a really nice guy, friendly guy, and I trusted him. And I think that that's very important, a trust issue, because someone like Michael is going to help very early on set up your business structure and your finances. Eventually, you're hopefully going to buy into a private practice, probably one of the biggest private practice decisions you'll make. And you need to think about life insurance as well, or the other insurances, and also building your personal wealth. So I think the key for this is finding someone that you trust early to establish a good foundation. And the other thing that I learned pretty quickly after building my private practice is that you're going to see your income go up, and suddenly you realize you're paying a shitload of tax, and you've got to try to minimize that somehow. And that's basically by finding legitimate tax deductions. And I have no knowledge on that, so that's why I relied on Michael.
Okay. And can I ask, how long after you finished your fellowship did you start seeing Michael or start getting advice?
I reckon it was pretty much in the first couple of months.
Yeah.
Yeah. So I came back almost broke because I did a lot of travel overseas, and I knew that I knew it was time to get serious and get some good advice, because when you're a registrar and a junior doctor, your income's not great. It's enough to live by, but taxes aren't that great as well. But then I guess I had the foresight to see that the potential to earn more money was there, and I wanted to establish financial security early, and that's why I felt it was important to get advice early and expert advice, because the longer you leave things, the more potential wealth you could squander by making poor decisions.
Well, that's what I was going to actually ask you, is knowing what you know now, how do you feel if you would have, say, left it 5-10 years down the track before creating that partnership with Michael? How would things may have been?
I think things would have been very different, because I guess the bottom dollar that you earn from private practice wouldn't change whether you had financial advice or not. It's about knowing what to do with that money, and so that's why, like in anything, if you need advice in a particular field, whether it be finances, medicine, or your pet dog, you need to find an expert who will give you the right advice.
Yeah. So we know that obviously it's difficult to save everything that we need for our retirement, or save to purchase into a practice or set up a practice. Finance is something that is going to be a part of our lives naturally, finance for home or investment or private practice. What have you learnt about finance and its relationship with where you've got to today?
I think that I still don't know a whole lot about finance, but one thing that is key is minimising your tax. And I remember when I first met Michael, very early on, he was discussing good versus bad debt, and because we're all medicos, he said, there's good cholesterol and bad cholesterol. And essentially good cholesterol is the debt that is tax deductible. So that's going to be business loans and all those other stuff, which I still don't quite get my head around. But then there's your non-tax deductible loans, such as your family home loan. So you got to pay those down quickly, and you got to to find all the legitimate tax breaks that you can. That's the key. Yeah.
Okay. You've obviously, as part of your practice, you receive a lot of referrals from colleagues, from patients and other practitioners, and you're well renowned in the industry for your technical expertise. And a lot of the people on the call will no doubt be sharpening up their technical expertise, because that's vitally important to them. But is that the only thing, or is that enough, do you think, to operate a successful private practice? And what value do you place on EQ or emotional intelligence?
I think that EQ is probably 80 to 90% of building a private practice. When you come back from fellowship, you're on the top of your game, and no doubt you're all technically competent, and so are almost all of your colleagues. What will set you apart from your colleagues is basically your bedside manner and your ability to establish rapport and trust with your patients. It's the same with any relationship. And so to answer your question, I think that EQ is vitally important. All you need to do technically is be competent, which we all are. And one thing that I would mention is in terms of building a private practice, you just got to get out there and meet your referrers early. So I called it the walk of shame, where you just got to hit the pavement, knock on all the doors, which is quite humbling because, as I said, you're on top of your game and suddenly you have to start sucking up to all these people, and it's quite demoralizing. And the way I saw things also is that your referrers will start sending you stuff. Usually it's the dross, the bad stuff, which is more of a pain than anything. But hopefully some of your patient will go back and feedback that this guy's a decent bloke, and then they'll start sending more stuff, and then you build your relationship that way. And I think the other thing that I'll mention is that things have changed a lot in the last 10 or 11 years. I think you have to be more patient now to build your practice. It's a lot more competitive out there now, and you just got to back yourself, surround yourself with the right people, whether it be financial planners or colleagues or friends, and hopefully make some sound decisions.
Okay, that's pretty good advice, I think. Bernie, is there anything else that you've learned post-fellowship that you think might be valuable to the group?
Look, I think that, again, I think the key is actually starting early. From personal experience, it's also important to get your insurances in order quickly as well. I was back 1 year from fellowship and I got very sick, and I didn't have my insurances up to date. I was only at registrar level. And, I potentially lost a lot of money because of that. So you got to get that sorted very quickly. And the other thing is that really building a successful private practice will give you financial success, but probably key is work-life balance. And that's not a secret. Everyone knows that's the constant struggle everyone faces, but it's particularly important to keep yourself mentally happy and well. The way I do that is basically trying to put my family first before my job, which is sometimes hard to do. But personally, if you're the most successful and busy surgeon in the world with millions in the bank, but you have no love and support of your family, then it's really all for nothing. So that would be my advice. You have to be work-life balance, be content with what you have, and and basically don't burn out, because if you burn out, you're not good to anyone. So really just a heartfelt thanks to Michael and Bongiorno Group. I can honestly say that we wouldn't be in this, I guess, financial position if it wasn't for their advice from an early stage.
Yeah, terrific. Thank you, Bernie. That's really, particularly talking about work-life balance and not burning out, I think that's probably a really refreshing message for everyone to hear. So thank you for that very much. I'll throw it back to you, Mithra. Thanks again, Bernie.
Pleasure, thanks.
Thank you very much, Gadjan, for facilitating that. And of course, thanks, Bernie, for taking some time out to talk to the young fellows. It's always good to hear from a young fellow how they started and their experience. Just a reminder to all attendees, you can ask questions. You just need to type it in the chat box, and we'll try and answer them mainly at the end, so at about 8 o'clock. Now, moving on, our next speaker is Michael Waycott. So he's a director at the Bongiorno Group. So we've heard from a fellow and how he started out, and the next thing is we need some advice, especially about how to set up the right financial foundations. So I'd like to introduce Michael Waycott from Bongiorno Group.
Thanks, Mithra. Hello, everyone. Welcome. And it was wonderful to hear Bernie's experience coming back from overseas, his post-fellowship, and how he's set himself up today. it's as Gage said, it's been quite an incredible 2020, and we're all looking forward for that calendar to turn over to 2021, and as Gage said, some new goals and objectives to be achieved. And I never thought that I'd be sitting opposite a computer screen during 2020 consulting with my clients who weren't operating. I never thought I'd see the day, and I'm sure my clients never thought they'd see the day. But we seem to have got through the other end, and we've got some really positive news with consistent 0 cases, up to 19 now in Victoria, which is terrific, and life seems to be getting back on track, which is great. Bernie, you've got a terrific memory about the good debt and bad debt, and in fact, we cover that tonight, so that's great. Gage, are you able to bring up the slides if possible? Thanks, Gage. I'll just get you to go to the next slide. So are we able to increase that? Oh no, that size is okay. Look, so what we're going to, just keep clicking through, Gage, we'll get the whole slide to pop up. So what we're going to cover tonight is just in a limited time frame. So I'm conscious of time frame to get through everything. And you guys are 1 to 5 years out post-fellowship. And before I continue, I really want to thank the Young Fellows Committee for putting this evening on tonight, and it wouldn't have happened without the work of Virginia and Mithra and Paul Cargill and Catherine Walsh on putting the evening on tonight. So fantastic work, and myself and Bongiorno is really humbled to be part of this and assisting you guys post fellowship out into private practice world. So these are the topics that we're going to cover: the taxation obligations. There's going to be different structures that people are going to talk to you about. Finance, which is, look, it's complicated, but it probably takes up a fair chunk of each of my meetings with my clients at the moment, because there's lots of different options to consider with finance. Interest rates have never been lower than what they are today. We'll touch on building wealth, and as Bernie had said, risk insurance, and what an important part that plays in your life. And we'll cover on that, because there are some big changes coming, and I'll explain that in detail. So next slide, Gage, if we can. So just go back one, Gage, if that's all right. Thank you. So your taxation obligations, look, sorry, move on to one. My mistake, go on to the next one. So when you're in private practice, you'll need to apply for an Australian business number, ABN. And if your private income is above 75,000, you'll need to register for GST, and you want to register for GST anyway. The income from private practice is generally input taxed, which means there's zero GST that you collect, and you don't need to pay on to the tax office the GST on your income. So you're claiming GST back on the expenses that you pay throughout the financial year, and you need to lodge one each quarter as you go, 4 quarters, which is preparing the business activity statement. A lot of clients prepare it themselves, and many clients don't have the time, which is a common theme amongst many of you online, no doubt, that you're time poor, and that's where we can assist in preparing the business activity statement for you each quarter. Tax planning is incredibly important, and which really goes into that last dot point of a tax honeymoon. And the tax honeymoon is where you move from a salaried position, you might be in public, and you commence in private practice, and there'll be a time where you don't actually pay tax on any of that private practice income until you lodge a tax return with that private practice income in it. So look, it's a little bit complicated, but if we just flick to the next slide, Gage, it just gives you a bit of an illustration of how this tax honey. So in year one, if you commence private practice in, say, July 2020, so if you've got your pens there, if you write down, some of you may already be doing this, but those that are just starting out, it's what we call PAYG, which stands for Pay As You Go Installment. So that's paying the income as you earn it. And the Pay As You Go installment will appear on your business activity statement. And when it appears on your business activity statement, it's based on the last year that you've lodged your tax return. Okay, sorry, I'm the opposite. The last year that you've lodged your tax return, which means they're assuming, they being the tax office, that you're going to earn similar income in in the next financial year. So they will divide it by 4, and that will appear as a quarterly pay-as-you-go instalment. So in 2020, you commence in private practice. The tax return that you lodge for 2000, and so you're in the 2021 financial year. So that ends on the 30th of June 2021. So the tax return for 2021 does not need to be lodged until May of 2022. So remember, the first time we've earned private practice income is July 2020. So the message here is work closely with your advisor and accountant. That's the tax planning part. The next part is the tax honeymoon. So you work out what your tax payable is going to be for the 2021 financial year, probably around September 2021. You know you've got to pay a big lump sum because you paid 0 tax all the way through that 2021 financial year. You know what your tax liability is going to be. Stick it in the esky on ice. We don't have to lodge it until May 2022, but as soon as we lodge that tax return and press the button, the honeymoon is over. So you've got to pay the lump sum tax, and then you automatically go into that pay-as-you-go instalment system. So because it's lodged in that June quarter of 2022, you will have a first instalment for the June quarter 2022, and will continue to pay each quarter. Now that counts towards your next financial year's tax. So you're prepaying a tax on your income. If anyone's got any questions on that, it is complicated. Usually I'm in front of an audience and I could whiteboard this and I get lots of questions. So please feel free to ask any questions if you've got on the pay-as-you-go honeymoon for taxation. All right, Gage, we'll move on to the next one. I just flick through these and just leave it there. Thanks, Gage. So look, your private practice structure options pretty much work like this. So we've got a company, a trust, and an individual. But the most important thing that I'd like everyone online tonight to understand is that the nature of the income that you're earning in private practice is what the tax office deemed to be PSI, which is personal services income. Okay, it's income from your personal exertion. So when you're in theatre, who do you employ? What do you own? And do you rent the rooms there? The answer is no to all of those. So you're providing your service and operating on that patient, and you're getting remunerated for your personal service in performing that operation. So in the eyes of the tax department, that is your income. And you cannot share that income with any other family member. So for instance, to give an example, to operate under a company structure, it's quite attractive because the tax rate is obviously lower than the highest marginal tax rate of an individual, which is 47% above 180,000 at this stage. Tax rates will change in the next couple of years, but right now, above 180,000, the top marginal rate is 47 cents in the dollar. The company tax rate is a bit lower. It's 30% in the dollar for every dollar. That's on retained profit. So income, less expenses, profit, you can leave that in the company if you satisfy a couple of tests and tax that 30%. Now, the test that you need to meet with the tax office, you need to prove and show that the nature of your income is of a business nature. And a solo practitioner, surgeon, operating under a company structure will not be able to meet that criteria. You can operate under a company, but the profit must be zero. And the profit is cleared out through paying a salary out to you, and you basically become an employee again of your own company, which, look, it creates complications. There's no asset protection under a company. You can check with a lawyer. I'm not a lawyer. I'm a financial advisor and accountant. But if you're sued by a patient, litigated, there's no company structure that you can hide behind. You are sued under your own provider number as an individual surgeon. The trust structure works in a similar way to a company, although trusts generally don't pay tax. They must distribute profits out to the beneficiaries. And it might be tempting to distribute out to low-income family beneficiaries, for instance. However, the same rules apply to the company, and the nature of the income that you earn, it's income from personal exertion. So therefore, who does the profit get distributed to? Of course, you, the doctor. So the last dot point is, I used to have a slide here which just had the letters KIS and another S with a cross through it, as keep it simple. And it really hasn't changed over the years, and that is to operate as a self-employed individual is the easiest, most uncomplicated form of structure. Income in, expenses out, pay tax on the profit. You're still able to employ your spouse for administrative purposes or whatever the case may be. Still able to superannuate your spouse and practice manager or secretary or whatever the case is, and you'll pay tax on whatever the profit is after expenses. So they're the three generally, and they're the ones that we get lots of questions on. Oh, you know, my mate Mark mentioned to me at a barbecue last Sunday, this is pre-COVID of course, that I should be operating under a company. Why are you operating as an individual? Well, they're the reasons why. So it's really important that we understand it's based on the nature of the income that you're generating from your patients. Okay, Gage, we'll just flick to next slide. This is what, look, it's a bit corny, but we've been doing this for years now. The way we look at finance is cholesterol, because our clients are doctors, and it works. So the avocado is the good cholesterol, and the large fries, McDonald's, is the bad cholesterol. So the fries is the home loan. It's debt, but it's debt that we can't claim a tax deduction on. And the HDL cholesterol is the debt that, well, it's still debt, it's still tax deductible. So it could be debt on an investment property. It could be debt secured against the home that you're using for business purposes, where if it's used 100% for business purposes, then the interest is deductible. And some of you, many of you on tonight may in fact be in the property market, and borrowing money today is very different to say 5, 6, 7, 8 years ago. And the process that you need to go through in getting an approval with the bank is a lot more complicated than it once used to be. And a lot of that's been come through with the Royal Commission into banking and finance, and the focus on whether or not mums and dads can actually afford the loan they're taking out, and the personal expenses that each incur on a monthly basis. There used to be a different formula to calculate what that was, and they used to use a very low rate, and it would be a set rate. So that's all changed now. But look, just flick to the next slide. Just before you do, sorry, Gage, just go back to it. It's really important that when we've got a business facility, that's the debt that's tax deductible, that's being used for business purposes, that you just avoid mixing that personal and business in the one facility. It makes it very complicated. It's going to make you pay more costs with your accountant and advisor, because you've got to work out what's deductible, what's not in terms of your interest, and complicated if the tax office were ever going to have a look at how you're using that facility. So strongly suggest you try and keep the business and personal separate. Sorry, Gage, you can push on to the next slide. Just keep track of time. Okay, so good segue into buying your own home. And go down to the next one too. We can bring it all up. Thanks, Gaj. So purchasing your own home. So who should own? Look, here in Melbourne, in Victoria, we had a wonderful planning tool that we used it for our clients for many years, that we were the only state in Australia that had access to it. And that was, there was no stamp duty payable between properties transferring from spouse to spouse. And sadly, that ceased on the 1st of July 2017. So it's never more important than now to understand who the right name of that property should go in. So some of you online tonight, you may have young families, and families might still be growing. You might be in the home that you bought 5 years ago, and as the family grows, you might outgrow the size of that property. And so what might happen is that you might be looking to upgrade the family home and purchase a new home. So look, there's many times I sit in front of clients who are under that exact same scenario, and what the idea is from the client sitting opposite me is that, you know, I need to sell and I need to buy. The first thing that we can do is work out, number one, what is your borrowing capacity? If we're able to keep that property and you rent it out, okay, and you rent it out, and that rent counts towards your servicing calculation of whether the bank will lend you money on the new one, and work out, because you can extract some equity of the property that you've held if you've held it for a period of time. And it's all based on whether you have sufficient income to hold the existing, depending on the debt level, and buy the new home at the level that you're looking at purchasing at. So we first do that to make sure, to see whether or not you're forced to sell because of the price that you're looking at buying on the new one. So look, we have a very strong relationship with Westpac, and it's just for doctors, and our clients certainly enjoy a very good relationship with the bank. And the things that we can do is that purchasing your own home, we're able to get access to lending of 95% without incurring lender's mortgage insurance. And what's lender's mortgage insurance? Well, generally, the general public can get access to, I'm just going to give you an example of what lender's mortgage insurance is. So they might get access to, say, 80% lending at the bank. They might have an exception, and they might be able to get access to 85 or 90% based on the strength of the customer. But the bank, it's outside of their lending criteria, so they see it as a higher risk. So they charge what's called lender's mortgage insurance. So just to give you an example, in the property market in Melbourne, on a $1.5 million loan, lender's mortgage insurance is $65,000, or just under $66,000 in fact. So getting that 95%, which generally you could probably get access to 90%, it just means you've saved that extra 5% in the cash account that's linked to the loan. So by borrowing more and keeping more cash, you're not paying any more interest than you need to. Okay, so having that additional lending capacity, buying the owner-occupier home at 95% is really, really advantageous. So who should own the home? Well, that's a very good question. And if you think that the home that you're buying today may not be the home that you're living in 10 years, maybe the high income earner buys this home that you're living in the interim, because potentially down the track, you might want to keep it and rent it out, and maintain the debt and just keep the cash in the offset account, and the offset account can then go towards the new home and reducing your non-deductible debt. I wanted to touch on interest rates, and I'll get to investment properties in a minute. Interest rates, they're at an all-time low. You can fix a home loan now. I think there's a 3-year rate at Westpac at 2.09. There's also a 4-year fixed rate at 1.99, which is absolutely staggering to see a rate at 1%. I just want to give it just a quick bit of history. Before the global financial crisis hit in 2008, I wish I could see you all and ask a question, But I wonder what you think the Reserve Bank cash rate was in December of 2007. I'd love someone to type it into the chat box, what they think the cash rate was with the Reserve Bank in December 2007, considering last week the Reserve Bank announced that the cash rate is dropping to 0.1%. So I can see 11%, I can see a 5%. Well, we're somewhere in the middle there. A 7%, very close. It's actually 6.75. So I was actually going through a client exercise. It's quite incredible. So we're going in 12 years, or pretty much 12 years, we've gone from 6.75 down to 0.1%. So with that last rate cut, the banks really didn't pass it on in any of their variable rates because they just can't. Their margins are so thin. What they did do, they passed it on through their fixed rates. And fixed rates, it's the first time in my professional career, and I know Tony Bongiorno, my business partner and founding member of the Bongiorno group, is online tonight. I think him and I would attest that it's one of the first times, well, certainly in my professional career, that I've spoken about fixed rates as much as I have over the last couple of months, simply because the rates are so low. And the Reserve Bank's got nothing to pass on in terms of stimulation. So it's all going to have to come from the banks. So it's very interesting. And just remember, so the investment property loans, you can get access to 90% lending again without lender's mortgage insurance. And if it's an investment purely location for capital growth, remember you buy property for capital growth. You don't buy property for the rent, okay? It's for capital growth. And you want to be as close into the CBD as you possibly can to get that bang for your buck that you're spending on the property. So no lender's mortgage insurance on the 90% lend. And remember, at the banks, there's a two-tiered rate system with a home loan interest rates and an investment loan interest rate. So just a tad higher. And look, I think every single client meeting I've had, I have spent a lot of time on looking at their facilities and see if we can improve them, because banks are very, very agreeable at the moment in terms of looking at your rates. Okay, let's keep going. Next slide, Gadge. So this is all sort of hand in glove, building your wealth. These are the different categories, and I wish we had more time, but property, I touched on that. You can't throw a blanket over every property and say it's going to double in 10 years. There are different properties. There are properties off the plan. Won't go there. What creates value in all property is dirt. The dirt that the house is on. It's not the house itself. It's the location to all the facilities around it, shops, schools, transport. It's the dirt that creates the value. And if it's only got one property on there, you've got a better opportunity of capital growth than owning one of 4 townhouses on that one block. Okay? So off the plan, the developer makes a lot of money. The second purchaser wins. If anyone wants me to elaborate on that, I'm happy to talk to them over the phone. My details will be up later on. Shares, look, it's all about diversification. So the problem with shares is, unlike property, shares, you know, if you're a nervous investor, shares might not be for you. It's as simple as that. I mean, shares have a value that you can see 24 hours a day. You know exactly what your shares are worth. Unlike property, you don't drive around residential streets and see neon signs out the front of a property, was yesterday, is today. It doesn't work like that. It's what someone's prepared to pay for that property on the day. Cash, well, I spoke to a client yesterday, and he's got some cash sitting in another bank's savings account, and he's earning, I think it was 0.45%. So you got to look at, am I utilising the best possible return on my money that I've earned, already paid tax on? Is that the best possible use of my funds sitting in a cash account, earning less than 0.5%? The other one there is superannuation. So, look, the government hasn't changed superannuation concessional caps. It's still at 25,000. I do recommend that everyone consider trying to maximise their contributions. You're in a low tax environment in the super fund, it's at 15%. You're getting a tax deduction at 47 cents in the dollar. If you're above 180,000, just remember there's a little sting in the tail. If your income's above 250, you'll cop another 15% tax, but you're still in front. And superannuation is purely a vehicle, and it's for savings. And you'll get access to that when you hit 65. It might seem a long way away, but it's actually for savings. It's for savings. So motor vehicles, no, I'm not a fan of expensive motor vehicles. So it's important that you buy something that is not going to affect your borrowing capacity too negatively. So spending the $200,000 on the Porsche, if you're looking at buying an investment property down the track, that's really, and you're borrowing for the $200,000 Porsche, it's really going to have a detrimental effect on your borrowing capacity. Okay, so far, I just want to just to sum up what we've covered so far. So just remember your structure. The income that you generate is income from personal exertions. Okay, income from personal exertion. So the structures that you've got options for you is a company, a trust, and an individual. And the simplest form of structure is the individual. What else have we covered? The difference between the debts, the good debt and the bad debt, the avocado and the large fries. Important to make a strong distinction between the two, and concentrate on paying off that non-deductible debt, which is the home loan. And the rates and the lender's mortgage insurance savings with the 95% loan with no lender's mortgage insurance is a sensational advantage to you. Again, this goes hand in glove. While you're building wealth, you're working hard, families. I haven't met a client yet who's been able to pay cash for a house or borrow or pay on Amex or credit card to buy a house. So automatically you're creating financial risk, and that is the debt. And your ability to continue to pay those debts that you're accumulating is based on you being healthy. Ultimately, your health and you generating income is going to ultimately determine whether or not you reach your financial goals and objectives. So what we need to do, what is really important we need to do is to ensure that you've got adequate protection. So just next slide, Gage. It's quite complicated insurance, but these are the forms of insurance. So there's income protection, okay? Income protection will cover you for 75% of your income. Life insurance is what it is. I don't think it needs an explanation. Trauma and critical care, critical illness insurance, it's major illnesses. It's heart attack, stroke, cancer, all forms. And it's you're alive, but you're sick, unwell, may not go back to work at full capacity, depending on the nature of the condition and the diagnosis. So it's an intention of a tax-free lump sum that's going to reduce your debt levels. Total and permanent disability, there's own occupation and any occupation. And in order to have a payment on that policy is you actually need to be totally and permanently disabled, as it's got on the screen. Needle stick is a very narrow form of cover. So it's covering HIV, Hep B and C. So basically it's a bloodborne disease, what it's covering you for. So look, I'll just flick to the next slide, Gage. What we've got is we've got some massive changes in the insurance industry. And that first slide, that first dot point, I should say, there's when you take out an income protection policy prior to 1 April 2020, it was what's called an agreed and endorsed policy. What does that mean? That means at the time of application, you have provided supporting income details like 2 years of your tax return, okay? And that means that the monthly benefit that you're applying for has been justified by the 2 years tax return that you've supplied. And so if you were to take a sabbatical, travel, or stop work for 6 months for whatever reason, and you had a claim on your policy, something medically went wrong, the policy that you got's agreed endorsed, it's rubber stamped. So you would get paid that monthly benefit regardless. You wouldn't need to show what you're earning at that time. Now, those policies are gone, okay? Any fresh, brand new policies, okay, from 1 April, other way, 1 April 2020 onwards, are what's going to be, next dot point gauge, is going to be indemnity policies, okay? They'll all be indemnity policies. Now, as the last dot point, this is a really interesting one. So if you've already got an agreed and endorsed policy and you guys online tonight, your income's going to go from here to here to here to here, okay? Because I've seen it. I've seen it happen many, many times. And you're going to want to match the level of risk insurance that you have personally with the level of income that you're earning at the time. So if you increase your income protection policy after the 1st of April 2020 on an existing policy, you still might have an endorsed and agreed policy because it's increasing the existing one that's been grandfathered at that time. But a fresh brand new policy is going to be an indemnity. What does indemnity mean? It means you need to prove you're earning that level of income at time of claim and at time of application as well, which is your tax return. Okay, next dot point gauge, or next slide. So that's the indemnity. Keep going. Look, the time, the clock is actually ticking at the moment in the insurance industry for those online tonight who are considering either, number one, taking out income protection, or number two, increasing their policy that they already have. There's some further changes that are coming through, tabled to come through on the 31st of October 2021, as you can see. And some of those changes, they're quite horrific, actually. So that 2-year owner occupation benefit then reverts to any. What does that mean? So you might have a situation where you've had a diagnosis where you've had some nerve damage on an arm or a hand, and you've lost a good amount of your dexterity, and you're on a long-term claim because you're unable to operate as an orthopaedic surgeon, for example. And that's gone past 2 years. So what they're saying is, if you've written that policy after a certain date, it's what's called an own occupation. So they'll pay you the monthly benefit because you can't perform your duties, your profession as an orthopaedic surgeon. What this is saying, these are on the table. So it's not policy and law, it's on the table. What they're saying is potentially, well, after 2 years, we're going to turn that into any occupation, which means couldn't you become a consultant or be a GP, a general practitioner, or something else in the medical field? So that's not what policies we have at the moment. So that's a big change. The payment of the policy also is a big kicker as well. And that is, if you were in public system and private system today, and it's an older policy, you might have some sick leave that's accumulated. You get paid your sick leave, but at the same time, you're getting your income protection. What they're saying is you're not going to get any more than 75% of your income from any source, even if it's from a road accident, sick leave. So I don't know how they're going to work this out, but it's, look, the message is tonight, seriously, if anyone's got any questions on income protection, call me. And we can work through it in your own personal situation. It's so critical to match your financial risk with your personal risk. And they've got to go hand in glove and ensure that you've got appropriate levels of cover. Welcome any questions on that. Next dot point, Gaj. That's it. I got through it. The other one, just one final one. There's no slide on it, and I think Bernie might have touched on it, and that's the importance of. He may or may not have mentioned this of estate planning. And as you accumulate, getting married, children, house, it's important that you have your own financial affairs under control. And what I mean by that, and looked after, so you've got a will, okay? You've got powers of attorney, okay? Really important. If anyone doesn't have a will, they should what they should do is go on Google and Google what happens if I die intestate, okay? In Victoria, each state has different rules, and it will actually say how your assets are treated. Thanks, guys. I hope that really helped. It's very exciting, you all going out into private practice, and I welcome any questions, and please don't hesitate to give me a call. Thank you.
Thank you very much, Michael. That was very, very eye-opening, and I think for a lot of us starting off in practice, a lot of this was never really told to us, so it was very, very, very important things. Now, next up, we have our question and answer session. So I'll open up to the panelists. So I'd like to, obviously, Michael will be hanging around. We also have Bernie here, our oral and maxillofacial surgeon. We'd also like to welcome Tony Bongiorno, who's one of the founding partners of the Bongiorno Group, as well as Gadget himself. So I might hand over to Gadge now. I think you might have some questions that have been posted.
Yeah, absolutely. Thanks very much, Mithra, and thank you to those who already posed their questions in the chat box. So we'll work through those. But to those of you who may have something on the tip of your tongue, don't be shy. Please do enter them in. So the first question I might ask of you, Michael, is if I employ my spouse through my company, am I able to retain profit?
That's a good question, Gadge. The short answer is no. It's still income from personal exertion. The only way that a company could retain profits in that scenario, if you had two doctors, two surgeons generating income into that company, one being the owner shareholder and the other one being an employee. So the ratio is a 1-to-1. I haven't seen it, so no, it doesn't work that way, unfortunately.
Just sticking with the company for a moment, Michael, and I think you might have answered this through your presentation, but just talking about companies, the question is getting paid through an ABN versus getting paid through a company ACN. Is there an advantage or a difference with both, or is there an advantage to the company?
No, there's no advantage. The income and a tax deduction is a tax deduction. It doesn't matter which entity you're operating under, whether it's a company, a trust, or an individual. If the expense is being incurred in relation to you generating that income, it's a tax deduction. And in terms of the business activity statement, you're better off as an individual, because operating through a company is very onerous. You've got to produce a profit and loss statement, a balance sheet. You've got to report to the Australian Securities and Investment Commission to do an annual return each year, which is a cost. There's a cost to set up the company. And what's the benefit? There is no tax benefit. There is no asset protection. So what is the benefit of operating the company? Nothing. So I think the best option is to consider operating as an individual.
So you gave the quite good example of the casual barbecue conversation. Why do you think it is that does come up? Because it does, we see it time and time again where people are operating companies or tell their friends too. Why do you think that is?
Yeah, look, I can only guess why, but in my experience to date, I think, look, we're really fortunate, and I'm so rapt that Tony's online tonight. I think we're very fortunate that our client base is doctors and dentists. So I guess we've been doing it for a long time, and we understand what the tax office will accept and won't accept. And there's nothing, there is a boundary line. There's nothing we would go outside that boundary line. And I think a lot of accountants and practitioners around the country have a really wide, diverse client base, and very difficult for them to understand every single industry and profession within their client base. So I think it may be a lack of knowledge out there in terms, because you've seen it, Gadge, I've seen it, I'm sure Tony has as well. You've got a new client that's come on board, and you look at their structure and what's been happening in the past, and yeah, it needs to be undone.
Yeah.
That's my guess.
Thanks, Michael. I'll move the conversation to got a couple of questions regarding risk insurance and specifically income protection, which I can ask of yourself or you, Tony. Is it beneficial to, when we talk about owning our income protection policy, is it beneficial to own that through my super fund? Tones, you're just on mute.
You can go. You can answer that one, Tone.
No, the answer is no. There is no advantage. In fact, it's probably disadvantageous for a number of reasons. Oftentimes, young interns start off owning their income protection in a super fund. But if you think of it logically, for someone in your tax bracket, if you spend $1,000 a year, the taxman's paying for 47% of it. So the net cost to you is 53 cents in the dollar, or 53%. If you're paying it by the super fund only gets a tax deduction of 15%. So that doesn't make any sense. And secondly, when you have a claim, it becomes a problem. So the answer is, I won't go into great detail. So the answer is, number one, you own it yourself. And number two, you make sure that if you've got an existing policy, you speak to someone about how you can actually add to that rather than replacing it, because you need to get advice on that one, because what you've got could be a bar of gold compared to what you're able to get today, and then in about 10 months down the line.
So when we talk, Tony, about income protection policies, then are all policies the same? And I ask that because some of the people in the audience might have an income protection policy on their first state super fund, for example, and they may think they're covered.
Yep.
What's the difference between that and other insurance providers?
Yeah, that's also a good question. Look, there's nothing wrong with having a small income protection policy in your super fund, except that the way that the insurers are working today, you can only ever insure for 75% of your income. And then once you get over a certain threshold, it dilutes to 50%. So essentially, if you've got something in your super fund, that would reduce the amount that you own outside super. So I'm not saying cancel it, I'm not saying that, but we're working with First State, who are now aware super, to advise on these matters. And I think if you probably get advice on that one. Some of them have restrictions on certain things. The wording's not the same. Look, there are probably half a dozen companies that pretty much on par, and they're specifically better for us because of the definitions.
That's right, and there's also, Tone, the benefit period too. A lot of the industry funds have a 2-year benefit period for their policy, where individually your income protection policy should have a benefit period up to, either 65 or the age of 65 or 70. So that's a massive difference on policies.
About 3 weeks ago, one of my young specialists, Gage, had a fall. I don't know, I think he was playing with one of his kids on a skateboard or something. And anyway, he broke his collarbone or fractured his collarbone. And just in conversation about 2 weeks later, I said, what are you doing? And he said, I've just taken 10 days off because I broke my collarbone, and it's a shame that I wasn't able to work for that waiting period of 30 days or whatever. And I said, well, here's the point of difference that you asked about. Is there any difference between insurance companies because the company that he had his cover with had a what called scheduled injury benefit. So he got paid 20 grand, even though he was back at work 10 days, 12 days later. So, yeah, there are differences like that.
Yeah, accident benefit option. Yep.
So when we talk about the changes coming up with risk insurance, and Michael, you mentioned the changes that are coming in potentially next year. What happens if we have an existing older income protection policy and someone wants to increase it? Do they need to renegotiate the original policy and get a new one, or what happens under the new rules?
My understanding is that you're able to increase the existing one. To date, unless Tony knows something else that I don't, that's where it stands today. That if you've already got an existing, say, endorsed and agreed policy, you're able to, and your income's gone up, you're able to increase that policy at the moment. Yep.
Could be a bar of gold.
So,
yeah, absolutely. It's like Willy Wonka's chocolate bar.
When we think about insurance, the people on the call, they potentially have home insurance, they've got car insurance, they've got private health insurance, and you've given us a long list of types of insurance being income protection, trauma, life. How many policies does someone need to have?
Well, look, there's no blanket rule, and it's up to the individual's own personal circumstances. Look, the later you leave it, generally the higher the cost, and also the more potential of maybe some other underlying health issues that may even preclude the applicant from being denied any form of insurance, or have some form of loading or exclusion based on any potential medical condition they have. So those list of insurances are the ones that you've got options to consider. With life and income protection are the main ones, and the trauma and the total and permanent disability, while they're lump sum insurance payouts, you're alive. And it just depends on what your personal circumstances are. It may or may not be applicable to you. But you won't know that until you sit down with your advisor and, number one, understand what do they cover me for and why do I need it?
Yeah. Okay.
Can I just add to that, please, Gage?
Yeah.
Before we were talking about a company, if you work or operate through a company, what we forgot to mention was that you're an employee of that company. And two things are triggered. Number one, you have to have work cover. That's a legislative requirement in Victoria. And that's going to be about $1,300 to $1,400 a year, which is worth absolutely zero because you've got your income protection anyway. The second thing is, depending on the level of income that you're paid out of that company, you could be eligible for payroll tax. So most surgeons, once they get beyond 600,000 a year, or 500,000 a year, plus there are people working for them in the company, they're over the payroll tax threshold, and it means, I know you probably all want to help the state government budget deficit at the moment, but that's aimlessly paying them 5.5% of anything over and above for nothing. You get absolutely nothing for it. So
That's 600.
I just had to mention.
Yeah, that's a good, real,
600,000.
bloody good point. It's over 600,000. So $1 million, 400,000 at 5%. So you're going to pay 20 grand to the state government.
For nothing.
Mm.
Yeah. Question for you, Bernie. We spoke at the top of the session just about all the good decisions that you have made over your private practice career. When we think then to what you might have seen out there, are there common mistakes that you've seen people make, and what would be maybe your top common mistake that you've seen?
Yeah, that's a hard one to answer because I don't really go into obviously my friend's financial situation. But you can look at the superficial elements. It's very superficial. I guess that we're all established in our own way in private practice, and my contemporaries anyway, or perhaps my older colleagues. And maybe, so, well, you know, they've been out for practices this long. I don't know their specifics, but, you know, maybe they should have done more, or I've seen, okay, just off the top of my head, I've seen people take on too much debt, actually, overextending themselves. A colleague of mine is 12 years older than I am and still working so hard because he has to. That's one mistake, I think, is not smelling the roses. And I've had another, well, my own mistake was that I didn't get my insurance in order early on. I had a serious illness 1 or 2 years out and paid financially quite a lot for that. And it's happened to one of my other colleagues who broke his ankle. And he was off work for a number of weeks, just short of 30 days. And so he couldn't work and that couldn't get paid out as well. So just off the top of my head, those are the mistakes I've seen. But yeah.
Yeah, I'll just jump in there, Gadge. It's look, Tony and I could give loads of stories, but I remember one particular story of a young dentist who just bought a medical practice, dental practice, and he'd only been in it for 9 months, and he's got a young family, and he actually built a billy cart for his son, and took him to the top of the hill and put him on the billy cart and sat him on his knee, and went down the hill, and the wheel fell off. And what he did was actually put his hand automatically under to stop it, and the wires cut into his fingers. So he had 3 plastic surgeons, 4 operations later. Thank God we had all his policies in order. He'd just taken over this private dental practice, and he got his dexterity back, luckily, but not without a few heart palpitations, and without that cover, he would have been in strife. No question about that.
Okay. I'll move the conversation on to we spoke a little bit about companies. We've got a couple of questions about trusts now.
Yeah, I saw that.
Which you get a lot of, no doubt. Now, question is, how do the people on the call, our guests today, set up a trust? And is there anything as far as structure that they need to be wary of? And I'll probably preface that by saying, adding to that, where is a trust beneficial for these guys?
Yeah, brilliant question. And usually there's a talk that we give each year, and I really get excited about this day that starting out in private practice at the college, and there's a lot who attend those days where they're actually going out into private practice, joining partnerships and other surgeons in business, and that's where the trusts really come into use. Look, a trust can be used for investment purposes, first and foremost, okay? You can use it to buy an investment property, but you need to be really careful that if you're borrowing a lot against that property, you might have a situation where the interest and the expenses are greater than the rent, therefore it's what we call negatively geared, and trusts don't distribute losses, it's quarantined inside that trust. But if you're going to join other practitioners and share rooms, for instance, you might have the ability to operate a structure. That's where a trust can be beneficial, because that's not that. So you're paying a service fee across. Look, it's actually a session on its own, Gadge, and you can enter into a structure where that trust is the entity that has the lease of the rooms, is the employer of all the staff, pays all the operating expenses, and the surgeons sit out here on the side, and they each pay a service fee because it's got no money to pay all his expenses. And that service fee is calculated based on an accepted formula by the Commission of Taxation, and that makes a profit. And the trusts, that income can go via your own trust, where you might have family beneficiaries where can be distributed down to suit tax purposes, because it's not income from your personal exertion, it's not patient fees. So really, just to sum up what I've said, it's really a business structure is where a trust really becomes a very, very good option for you. Investing is another option, but you just got to watch how much borrowing is attached to that investment.
Michael, someone asked the question about how you set up trust, and we've got a very good document about what we're preparing for the AMA. So we're happy to send that to anyone.
Terrific.
And that basically, if you just write to Mitra or whoever, and we'll send it to you. And it basically is a very, very simple. I've actually got a cut of it on my desk here, and it's really good. It very simplistically explains who the different people are, who the different parties are, and how you can actually use it. It's very simply written.
So part of what's driving, I think, some of the questions around companies and around trust is that notion of financial security. So obviously we've ruled out companies in some respects from that point of view. How do doctors and people in private practice provide financial security for their children and for their family?
In what respect? In terms of asset protection?
Asset protection, yeah, correct.
Okay, asset protection. Look, asset protection, you can have assets owned in different entities. Look, a lot of our clients' homes might be in the non-doctor spouse's name, for instance. Okay, there might be other properties that are owned under a trust structure. We've got other income going into that trust, and they are protected in that trust with a company act as a trustee of that trust, and minimal assets in the doctor's name. Look, there wouldn't be much that Tony hasn't seen over the years, and he might want to add to this. Have you got any other commentary around that, Tone?
In 52 and a half years, I've only ever had one doctor that's had an issue with asset protection. The current medical indemnity insurers, I think the threshold's about 12 or 14 million dollars. And the largest case that I can remember was about maybe 10 or 12 years ago, when an accountant went in to one of the regional hospitals, and I'm trying to remember what actually happened. They, instead of giving him, he was having some form of chemotherapy, I think from memory, and instead of giving him at the time an IV with chop in it, and he was having methotrexate. They gave him the IV with the methotrexate, and the methotrexate and the chop got mixed up. So the methotrexate went in as an IV drip inadvertently. I think the guy had some underlying heart condition as well, and I can't remember the outcome, but I know that was one of the largest claims that the insurers have paid. That was something like about $6 or $8 million, and there's rarely any massive claims. You just want to make sure you've got your professional indemnity, be it with MDIV or Avant or whoever it is. You've got to make sure that's always covered.
There used to be an article.
So you're pretty.
There was an article floating around, I don't know, 7 or 8 years ago, that there was no doctor who'd actually lost their family home through patient litigation. I remember seeing that.
No.
So, yep.
Okay. Thank you, everyone. That's the questions we've got in the chat box for today. If you do leave today's conversation and think of a question, please do get in contact with Michael or Tony, or certainly the college can send through your questions as well. But thank you to our panellists today. I'll hand back to you, Mithra.
Thanks, Gage.
Thank you once again, everyone. So I'll start firstly with Bernie. Thank you for taking time out to talk to some of the young fellows and giving you some of the some wise words about how to start off. And of course, thanks to Gadge, Michael, and Tony from Bongiorno. So for those, again, who have not heard of Bongiorno, they are a financial company. And they specialise in advice in the medical field. So they sponsor a lot of our college functions, and in particular the Preparing for Private Practice function course, which I attended last year and I found invaluable. So just a reminder to everyone that there will be a recording. So if there's anything that you need to go back and have a look at, there will be a recording, and it'll be available on the RAC's website in the next couple of days. And I understand, Michael, you're happy to offer some complimentary Zoom or face-to-face sessions.
Yeah, absolutely. Yep.
If need be. So I think all the details will be up on, or did you want to tell people how they can contact you? Or I think
I was on that last slide. Well, the contact number is 98633141. But if you go to our website, my email address is mwaycott, WAYCOTT @bongiorno.com.au. I could probably put it in the chat box.
Actually, just got a message from Virginia. She's going to put it up on the RAC's website.
There you go. Makes it easier.
That makes it easier.
Yep.
So thank you once again, and thanks for everyone that has attended and watched. We appreciate your help and support from Bongiorno. And to the young fellows, good luck. And, try and get involved. Just a plug for all the college young fellow functions, like the Young Fellows Forum and all the sections at the ASC. Try and attend them. They are great fun. It's a great opportunity to socialise. So thank you once again, everybody. And hopefully we'll be seeing you in person soon. Hopefully in not too long. Thank you.
Thanks, Mithra. Well done.
Thanks, Mithra. Thank you. Thanks, Mike.
Thanks, Tone.